Hi, I'm Bridget Sullivan Ramel. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shear. I've got a fee-only financial planning practice in Middleton, Wisconsin. Before we jump into today's episode about tax planning under the new tax bill, just want to remind everybody, hit that subscribe button, click on that like, and help other people find this information on YouTube. And with that, I'm excited to talk about taxes. I'm not sure if those two things go together, but I'm interested in hearing. We've been doing tax planning for our clients, as I know you have. Interested to share some ideas and sort of what things, Bridget, you're seeing as being the biggest impacts, what the value is for our clients, and what viewers should be paying attention to here as we go through the fourth quarter of 2025.
Yeah, so when we put our information in, we get all the information from clients, put it in our software. And then we want to make sure we tell them kind of what's new and what applies to them. So that's kind of what I want to go over today.
Yeah.
So the first thing is this handout, because there's a lot of things that have been passed and they sound good, but the way that they got so many different things passed to help so many different people is to have income limits and qualifications on them. And the big thing is income limits. So it's important to understand kind of what your income is going to be and then what are the income limits. And so and then let's talk through what the actual items are. The first one is the SALT deduction. So this is if you are salty, you pay state and local income tax. Okay. And that is what is called SALT. And there's a lot of debate about that because previously in 2024, you were the most you could take, and this is an itemized deduction, is $10,000. Now they've increased that to $40,000. And that is if you're single or if you're married filing jointly, it's the same amount, 40,000. Okay. But if you're making a bunch, it gets phased out and then goes away. Okay. And then you go back to 10,000. So, and that phase out right now, I believe between 500 and $600,000 in income. And that again, if you're single or married filing jointly, no problem. Now, this impacts a lot of people in Illinois because if they pay, our state tax is about 5%. And so, especially so let's say a single person is making $300,000, that means they're going to just already pay $15,000 in state and local tax. So that almost gets them to itemizing just with their income tax. And if they own a home, they've got property tax and interest. And if they give some money to charity, they've got some deductions there. So this will get more people to itemize. What's
Yeah, and just to be clear, I wanted to bring up, and I'm following, but make sure viewers see here that so we say income limits, right, which makes
right?
sense, and that phase out range is the income limit, right? Like those two things are sort of connected, and on I love this diagram. First of all, I think this is awesome,
Well,
but on that
it's
salt, oh
Michael Kitces, just so you know.
oh yeah, okay, good, yeah,
Um,
kitsis.com, right?
right.
So on that salt deduction, the income limit is basically under 500,000. There's no very, it all works the way
40,000,
it
you get
works.
40 grand. Yeah.
Between five and six, that number gets
No,
phased out. And then to the right of that, over six, then you don't get it. Is that right?
10,000.
Yeah, yeah,
So it's
yeah,
not zero, but it's
yeah.
10,000. It's back to what
But
it
yeah,
was.
back to the old law. Yep,
Yeah.
perfect. So it's that phase out is left side totally in, right side out, or different rules, and in between it's scaled back.
Right. So it's definitely
Yeah.
helping people who are making less than $500,000. And if you're around the 300 to 500,000 mark, it's got more of a likelihood to help you. Okay. Next thing.
And that one's going to be a major change, right, over last year. Some of these other things are additions are, but like if nothing changes in your life, your tax situation could change dramatically if you fall into that situation, right?
Right. And
Yeah.
it takes effect in 2025.
So this
So
year.
this year. Yeah.
Yep.
And it keeps going in 2026 as well. So that's an important part too. The next one
Yeah,
we've got
great.
is the itemized deduction limitation. And this is basically to say if you're making a lot, say if you're in the 37% bracket, if your tax practice is 37%, then starting next year, your itemized deductions will only count like 35%. So
You don't get full credit for them.
you don't get full credit. So, but it's a kind of a chipping away more than And it's hard to plan. This is one that'll be a little bit hard to plan for. Okay.
Yeah.
And then here's another biggie. Okay. So the other biggie besides the salt is $6,000 to everybody over 65. Here you go. And this is just, it's not a credit, it's a deduction. Okay. However, we got income limitations, and that's the biggest part about this one. And so if you're single, the income limitations, the phase out starts at 75,000. And if you're married filing jointly, it's at 150. And this includes how much if you're getting Social Security, how much Social Security is getting in there. So this will help. This has been helping some of my clients a lot. And it also is one of those factors, like, so if someone's in a situation where we're thinking about doing some Roth conversions and that type of thing, it's another factor when we're thinking about not doing Roth, it's another factor against it. Cause
Right.
income limits are lower, so it affect more people. So I don't know if you've seen that impact people, John.
Yeah, absolutely. And just looking at those top 4 or 5 items here, I mean, these are a lot of the things that we've been talking about with folks. That salt deduction, the increase, right, makes a big difference for people that maybe didn't itemize last year, now will be, or did itemize and it's going way up, right? A big delta on those things, a big change, but not if you're above 600,000, right? If you're one of those lucky people making a whole lot of money. It doesn't affect you, or maybe maybe you sold a business or did something, and you're in that situation where it's so many
Right.
variables.
Could be a 1 year thing,
Right,
Just
right. And then on the other end of things, we got, the folks that are retired and now the limits on those things and the rules are in that, like, 250 and under range where you get this credit except for if you don't get the credit, right? And, all these and just interesting as I look at this and that diversity of, I mean, this is why you have to take a look at this every year because it's not one-stop shopping. It's not the one rule applies to everybody. And the one rule might not even apply to you based on what we just said,
right.
depending on what happens. And you did a big Roth conversion, you sold a business, or you retired and now your income's way lower, right? Like it just changes every year. And these are those are the ones that we're really seeing that salt deduction, looking at itemized deductions really closely. And then that 65 and over, it's a deduction, but it's kind of separate from your itemized deductions, right? So
Yeah.
it's two different things on there, but those are the places, we like doing Roth conversions. So meaning when somebody gets to be retired and they don't have to take money out of their IRAs yet, but they might want to because of taking advantage of lower tax brackets.
Right.
That new senior credit, I think they call it a senior citizen credit, which is just a weird word for it,
I think
or
it's
weird
actually
terminology.
meant to be technical, sorry. Uh,
What was that?
it's a deduction.
Deduction. Yeah, yeah, yeah. No, right. Thank you for it.
Well,
It makes a
jargon.
difference.
Yeah.
But we've seen somebody, and we've had somebody, and they're maybe in the 10 or 12% tax bracket. And we go, oh, cool. We
We
want to pay more taxes at that low rate, but adding even 10,000. We had one situation adding like $10,000 on that next 10,000 was actually taxed at like 30% because you lose this deduction and then this, and then Social Security gets taxed more.
Yeah.
But if they did 50,000, the tax rate actually was only 15%
Right.
because, right, so a little bit is taxed a lot and more was taxed at less, and then the tax rate went up. And it's just, you have to look at this as the one big takeaway. You have to run the numbers and see what it looks like because you can't say, oh, I fit this category. Great. That's my whole situation. There's so many moving levers in this.
Yeah. And then we've got some others that are the tax on tips, the no tax on tips, the no tax on overtime. You want to look into the details. And also there are income limits on that. And then auto loan interest, again, if you're interested, and we had a viewer ask about it, you just got to look, you got to dig in a little bit. And we'll have a link in the show notes to this to Michael Kitsis's website. And they call the writers a senior nerd. And they write really clearly about all the detail. And so that's what we look
Yeah.
at when we're trying to advise people often, not always. I love the IRS's website, but a lot of times this gives a little bit of interpretation and is helpful. Then we get the child tax credits, and that's just an increase. And there's no actions that you can take. I guess you could have a kid or, That it would have to be already done already. So let's talk about the other itemized deductions. And this is more about 2025 versus 2026. And we got another list, another chart again from Michael Kitces that talks about the TCJA, that's the old law, OBBBA, that's the new law. That's 2020. Yeah, that's the new law. Okay. And then the year the changes take effect. And so this gets a little bit more into if you're itemizing. And I put one, I added a little post-it just so I remember something too. So medical and dental expenses, no change. Same deal, 7.5% of your AGI is what you use. You have to take that amount off of whatever your medical and dental expenses. I do want to mention though, that this does include if you're paying Medicare or Medigap and long-term care insurance, all those things can get included here. So sometimes people who are retired think, well, I don't pay anything for this. Well, it can, all that stuff can add up. Next is SALT. We just talked about that a lot, state and local income tax, and that fact that happens in 2025. Mortgage interests, pretty much the same as before. I think PMI counts in 2026. Great, whatever. We did an episode on charity on this, but I'll just mention it here. Starting in 2026, two things happen. One is if you're itemizing, you're subject to a 0.5% of your adjusted gross income. Who even knows what the heck that is? Who can do that kind of percentage work in their head? But I'll tell you this, make 100,000, that's $500 deduction. So if you then donated $2,000, you'd say $2,000 minus 500 equals 1,500 would be our actual deduction. Okay. It starts in 2026. A little bit of motivation to move if you're going to donate this year, if you're itemizing in both years, because that's the itemizing. But if you don't itemize starting in 2026, it's $1,000, you can get $1,000 deduction per person for charitable contributions. So if you're married filing jointly, that's 2,000. If you're single, that's 1,000. So charity, always a hot issue. Casualty and theft. I don't keep casualty and theft itemized deduction in my brain, because if it happens, then you look it up and figure out what the current rules are. That's what I would say, because it's something you just do reactively, not proactively. Miscellaneous itemized deductions, not much there anymore. We think that educator expenses might be there. I don't know. And then overall limit, and this is something that we talked about previously. If you're making a lot, you don't get the 30, doesn't count as 37% deduction, it counts as 35.
Yeah, I think that the big one that we've been seeing that makes a difference. I love what you said about the theft loss and also like you can't plan for that. No, it's there, but you can plan for those charitable giving things, right? And take a look. That new floor comes into play in 26, but also the new $1,000 per person if you don't itemize comes in 26. So that might make a difference in somebody's charitable giving if they choose to give in 25 to avoid the floor, or if they choose to wait till January 1st of 26 to get that $1,000. So that's one of the sort of action items we've been seeing with folks.
Right. And so we've been also saying, okay, we've even had a big stock run up. We had another episode on that. Maybe I should donate some of my appreciated stock in my donor advised fund. Maybe I'll do it this year to avoid the 5%, the 0.5% reduction instead of next year. But those are pretty subtle changes. And again, we had an episode on it.
Yeah, that's great. Hey, I think that's a great place to wrap things up. A lot of tax changes. Be prepared for it here in the fourth quarter of 2025. Again, I'm John Shear. I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Ramel. I've got a fee-only financial planning practice in Chicago, Illinois. Both John and I are taking clients, so you can contact us if you're interested. If you're looking for an advisor in your area, we're both proud members of ACP, or the Alliance of Comprehensive Planners, and you can find planners at acplanners.org.
And don't forget, hit that subscribe button.